Hello and welcome to the Kingsview Investment Strategies Q2 mid-quarter update and portfolio update. I'm Scott Martin, Chief Investment Officer of Kingsview Asset Management and Portfolio Manager of Kingsview Investment Strategies. And joining me today, Paul Nolte, Senior Vice President and Portfolio Manager at Kingsview Investment Strategies. Paul, thanks for joining us, taking the time once again on your busy schedule.
Always fun.
Yes.
Always fun.
Well, okay, first of all, as I noted on the intro, it's already mid-quarter. We came to you a little over a month and a half ago talking about some of the portfolio machinations that went on in Q1 and some of the changes we made, and it's about time, I think, to review the ones that have been made so far in Q2. Paul, catch us up quickly on, say, what's been going on so far through April and part of May, both in the markets and the portfolios thus far.
Yeah, the markets have been remarkably quiet if you look point to point. Volatility is still with us. We still see 100, 200-point days on the upside, downside. The market, I think, has shifted a little bit more away from the news of the day, meaning earnings, economic data, and is now more geopolitically focused. So a lot more information coming from Korea, from trade, tariffs, Iran,
Oh
we
my
just
God.
got today.
Yes.
So the markets, I think, are a lot more focused on the geopolitics, less so on the earnings number. The earnings were fabulous, but you did not really get a good reaction from that. And that gives us a little reason to pause. You would expect the markets to really jump on those numbers. They didn't. And part of the reason why we've gotten a little bit more defensive in the portfolios, and we've pulled back here a little bit.
I'm shocked about the earnings stuff because that to me was almost going to be the saving grace of some of the volatility. And while I believe it has probably pulled some of the volatility down, it hasn't exactly pulled it up either in the sense of to the upside. You know, I mean, you mentioned it. Earnings, whether it was in the tech sector, financials especially, industrials too. Really just a really lame reaction. So you mentioned it, and let's talk a little bit more about it specifically. In the portfolios, the multi-strats and the like, we've started to pull back some of the exposure on the equity side in light of, say, some of those bad reactions, specifically, I guess, in tech, yes?
Yeah, in tech especially. We've had a 2-year run in technology. Technology has been the market leader. Apple is now approaching $1 trillion market cap and is certainly one of the big leaders for the market. But technology has had that long run. We're now getting late in the economic cycle. We're not sure exactly what inning we're in, but probably late 8th, 9th inning here of this economic cycle. So as we start to shift, we're going to see inflation pick up. We're going to see interest rates pick up. We probably will see the economy slow down at some point over the next 6 months to maybe a year and a half. So all we're trying to do is stay ahead of it a little bit, shift the portfolios, raise a little bit of cash in deference to higher interest rates.
Volatility, sure,
volatility
yes, absolutely.
is
And maybe get things that have a possibility to definitely, I think, increase non-correlation in the portfolios, which, as you know, especially in late inning ball games, as you said, not sure what the score is here. If the Cubs are on the field, it could be either they're at 0 or 12, as I think we saw last night. They're kind of feast or famine on the offensive side. But similarly, too, I think some of the investments. I mean, you mentioned the cash that we've raised, the pull down that we had in some of the tech positions. Commodities, you mentioned late cycle. Let's go into some of those areas that we've added to the portfolios.
And certainly commodities are one of the areas that we would, in the late cycle, you would expect to pick up. So we're taking a look at gold. We're looking at the metals. We're looking at stocks that do a lot of the mining, the finding of oil and water and all of those types of things. So again, we're still looking at the stock side, not necessarily the direct ownership of commodities, although we can, and it's much easier to do with gold. But again, get that exposure that's a little bit away from the market and anticipating a change in the market psychology as well as in the economy over the next 6 months to a year.
Bring us the goal of maybe increasing the return while decreasing the risk, which is really the value of adding some of that non-correlation. Another component to the portfolios we run at Kingsview Investment Strategies that many of you invest in is the fixed income side. Interest rate related things, credit related things when it comes to treasuries or corporates. Can you talk a little bit about how we've seen interest rates behave, say, up to this mid-quarter point, as well as how we've kind of tried our best, I guess, to position around what's been a pretty volatile interest rate environment, especially as you move along the curve?
It's true. And one of the things, I mean, the thing to remember with fixed income allows you to sleep at night. It is an offset to the equity exposure that we have. What we try to do is trying to keep right now, because the Fed is going to be raising rates, our expectation is 3 more times this year, 4 total, maybe a couple more next year. We want to be relatively short duration, which means The benchmark duration or the volatility of that is about a 6 or a 7. We're wanting to be about a 3 or a 4. So we want to be on the shorter side, which means the portfolios turn over a little bit more. We capture the higher interest rates as the interest rates start to rise, and look away from some of the treasury type of investments, and look maybe a little bit more away from the equity type of fixed income. So high yield, we've taken down a little bit. We've made some adjustments there. So we're staying away from the equity-like fixed income and going with a little bit more safer security.
Yeah, and I think staying shorter in duration, as you mentioned, shorter term securities allows you, like you mentioned, to be a little bit more flexible, because let's face it, I mean, one thing that's happened that I always laugh about, and I've seen you kind of joke about it on TV too, if I may say, is that interest rates were supposed to go to the sky by now, right?
Yes.
Inflation was going to go nuts, and bonds were going to be in this terrible bear market. Now, yes, bonds have not been a great investment in the last 6 to 8 months, but in the last couple of years, they've been okay. So I think it's one of those things, possibly, Paul, where I like the fact that we've been very nimble on the fixed side, trying to go in places where maybe there aren't a lot of dollar flows just yet, or places that have been shorter in duration than typically you'd see in a lot of multi-scale portfolios, because of the fact that sometimes when things are such a foregone conclusion, they're exactly not that.
No, that's true. And really, when you take a look at it, we've been in a 30 to 40 year bull market in bonds. The only inflation expectation or inflation experience that many portfolio managers have is the 70s and 80s. So we saw inflation skyrocket, interest rates skyrocket, bonds fall apart. But we've had other periods of time in the last 200 years, 150 years, that we've seen inflation pick up, but not to the dramatic effect of the 70s or 80s. So everybody is modeling off of that. And I think that's wrong. We will see higher inflation, but we're not going to see that crazy inflation that we saw in the 70s and 80s. We'll see some higher inflation. We'll see some higher interest rates. It's a different environment, I think, than what we saw during the 70s and 80s.
Yeah, I agree. So good to stay flexible there. Well, that should finish up the update for the mid-quarter from Kingsview Investment Strategies. Paul, thanks again for joining us. Keep in touch with your advisor if you have any further questions or comments about what we said today. Thanks again for joining us.